Everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in today. We're going to produce a series of videos, kind of mini lectures on the history of the U.S. Federal Reserve, which is the U.S. Central Bank. It's not a very well-known institution, and I kind of cringe, especially when we get into political season, when I hear people talking about monetary policy and they don't really understand the institution and what it does. It's been in the news recently, of course, because interest rates have been relatively high recently and they're starting to come down. And for a significant period after the financial crisis, rates were very low, and I think the Fed was not given as much attention as it might have otherwise. So now that it's coming in the news, and it's also in the news a lot because of our political candidates and their supporters who are kind of thinking that interest rate policy would be in the domain of whatever policies they would propose, which is not the case, but we're hoping that we can clarify what the institution does. So I think a good starting point is just to describe or define what a central bank is. Central bank in the broadest sense is an institution, a national institution that is responsible for monetary policy and credit policy in a country. And the first institution that was considered to be kind of a central bank was the Swedish Riksbank, and that was established in 1668. And then the best known, at least of the early central banks, was the Bank of England. That was established in 1694, and it was established to lend money to the British government. War finance always enters into the picture in the history of banking and central banking particularly. Now, the Bank of England was by far the most important central bank up until the early 20th century, when the United States really starts to become a major financial and industrial power. The United States did not have a consistent central bank until the founding of the Federal Reserve, but it did have institutions which in the past had taken on some of the roles of central banks. Now, with the Bank of England, they were the first institution to really embrace what we'll see as one of the most important functions of a central bank, and that is to act as the lender of last resort. So during a period of crisis, a central bank provides liquidity to the financial system. And it was really the Bank of England in the mid to late 18th century that started to embrace this function. And that lender of last resort function was popularized by a journalist named Walter Bagehot, who published a book called Lombard Street in 1873. And in this book, he talks about central bank and the Bank of England particularly, how they should lend freely at a penalty rate and against good collateral. And we hear that term, we hear the term Bagehot's dictum a lot, especially when Bernanke and other central bankers talked about the financial crisis. So that was really kind of popularized in 1873 with this book. And we saw that with other central banks throughout their history. Now, getting back to the U.S., we did not have a consistent central bank until 1913 when the Federal Reserve was founded. But before that, we had several institutions that had acted as kind of quasi-central banks. The first is the Bank of the United States, which later became known as the First Bank of the United States. This was the result of a long drawn-out fight particularly with Alexander Hamilton and Thomas Jefferson. But Hamilton eventually convinced Washington to enact a national bank, and that was signed into law in 1791. It was given a 20-year charter, and what's important to note is that the U.S., especially in the early republic, our founders were very averse, most of them were very averse to the concentration of power. So there really is this populist history within the U.S. government that was very averse to a central bank. So the first Bank of the United States, it did take on a lot of the functions of what we now know as a central bank, but that charter expired in 1811. And then we had another attempt at a central bank in 1816. This became known as the Second Bank of the United States. This was structured in a very similar way to the First Bank of the United States. That was also given a 20-year charter. And President Andrew Jackson, it was a very famous conflict between President Jackson and the president of the Second Bank of the United States named Nicholas Biddle. And these were actually called the Bank Wars, and this was a big part of the Jackson presidency. The charter expired, this also had a 20-year charter. The charter expired in 1836, but 3 years prior to that, Jackson pulled the federal deposits out of the Second Bank of the United States, and that kind of ended the Second Bank's reign as a central bank. So it effectively ended in 1833. The third institution which acted as kind of a central bank was in 1846. There was a bill signed that created what was called the independent Treasury system. And under the independent Treasury system, government receipts were held outside of the banking system. And from 1846 up to the founding of the Federal Reserve, the Treasury itself, by managing their funds outside of the banking system, could act as kind of a central bank. They could put money in and against, and they could to the banking system, and they could expand the money supply. It was not a very effective institution, which is why the Federal Reserve eventually became an institution again in 1913. In the next video, we'll talk about the national banking system, which is the banking system that existed right before the founding of the Fed. And we'll talk about how that system evolved, and we'll talk about some of the banking crises that were inherent in the national banking system that really kind of led to the founding of the Fed. Thank you for tuning in. We'll see everyone next time.